Singapore's central bank warns that the country's growth this year will likely be weaker than earlier expected as the US-China trade war continues to bite. Policymakers are reviewing their GDP growth forecast for this year, even though it was just narrowed last month. Cheryl Lin with more.
The Monetary Authority of Singapore is bracing for a rougher ride ahead as the three engines of global growth have stalled: manufacturing, trade and investment. Of the factors driving weakness in these areas, MAS's Chief Ravi Menon says the US-China trade conflict poses the biggest risk.
MAS estimates that the direct impact of the tariffs that have been introduced to date would already shave off a cumulative 0.3 percentage points from global GDP growth over 2019 to 2020. Now, the indirect effects on business and consumer sentiments and financial markets are difficult to estimate. Some analysts believe that these indirect costs or effects could be even larger than the direct effects.
Beyond the tariff war, a new and unknown risk, as Mr. Menon put it, is the broadening of the trade dispute to the technology front. He said that any moves to restrict the supply of critical technology could lead to significant disruptions in value chains. And the tricky part is that we don't fully understand yet the dynamics of these value chains and technology dependencies. Despite this, the global economy is not heading for a crash, Mr. Menon says. Still, the slowdown is hurting Singapore.
The Singapore economy is being clearly affected by the global slowdown in manufacturing, trade and investment. The economy grew by 1.2% in Q1 this year, compared to 3.1% for full year 2018. Recent indicators suggest that growth in Q2 could be lower than in Q1. Non-oil domestic exports have contracted by 9.3% since the beginning of this year. The manufacturing sector is in a sharp downturn.
For that reason, he says authorities are reviewing the GDP growth forecast of 1.5 to 2.5%, even after it was just narrowed last month. He also predicts that modern services, including finance, information and communication services, will drive growth, while trade-related clusters decelerate. However, Mr. Menon says underlying inflationary pressures should be contained. He adds that the finance sector is a bright spot, generating 6,900 jobs and growing at about 6% for 2018. He adds that MAS's unchanged monetary policy stance after tightening twice last year will keep the economy close to potential. But one analyst says this stance might have to change.
With the way that things have been going, things have been sliding, deteriorating worse than they have expected. My guess would be that they are going to probably have to reverse some of that tightening that they've done. So we are expecting an easing of monetary policy in October to try and lighten up the load on the policy side and give a bit of a lift to the economy.
Finally, Mr. Menon says that while external headwinds will slow Singapore's growth in the short term, domestic restructuring is going well and will enable the economy to come out stronger.